Central Bank of Nigeria, CBN, has increased the monetary policy rate by 200 basis points to 24.75% from 22.75% to address escalating inflation. Governor Olayemi Cardoso announced the decision at the 294th meeting of the Monetary Policy Committee press briefing in Abuja. This marks a 2% surge from the previous rate set a month earlier, constituting the second hike under the current committee's tenure. The CBN governor had mentioned the exchange rate, adding that the Apex Bank would ensure that the market remains flexible.
I believe that we are on the right course, and of course, one particular area of chair as a result of the actions we have taken is the moderation in the foreign exchange rate, which you have seen. Now, don't take the foreign exchange in isolation because it does have major pass-through to inflation. And to the extent that we've seen this happen and we expect it will continue to moderate, we are confident that these tools and measures that the central bank is using will ensure that, the inflationary spiral will gradually be brought under stricter control.
To discuss this, I'm joined by Chief Economist, SPM Professionals, Paul Alaje. Thank you very much, Paul, for giving us your time. A 200 basis point just about a month after an initial 400 basis points increase. How did that come to you? Did you expect it? Paul, you need to unmute. We can't hear you.
Thank you so very much for having me. Thank you so very much for having me. I must say that first, it came as a surprise. Having had 400 basis point increase in interest rates, no one would expect that the Central Bank of Nigeria and indeed the Monetary Policy Committee would increase MPR by another 200 basis points and further adjusting asymmetric corridor as well as the cash reserve ratio or cash reserve requirement, as the case may be. The implication of this is that one, central bank and the MPC have sent indicator to Nigeria and indeed the rest of the world that the core mandate of the central bank is combating inflation as evident in price stability, and they will do everything to ensure they bring inflation down. Now, for every economic decision, there seems to be consequences. The immediate consequence you would see in bringing down inflation will be one, you are going to see that this will crowd out investment, and it may also have tremendous negative impact on those who have borrowed money already or anyone who may want to borrow from bank for the purpose of business. Implication, it will crowd out employment. I was not surprised when the Bureau of Statistics released the last figure of the unemployment and reviewed the unemployment has significantly increased by an additional 20% of what it was, or 4% now to 5%, and still growing beyond. Implication is, yes, central bank is saying we're alone on this. We're going to find our battle alone. We'll make sure we combat inflation and bring it down. So you're going to see some investment, foreign direct investment, especially, and I need you to underline this, especially in the portfolio market. So you see some foreign direct investment coming to Nigeria, going into buying bonds, bills, treasury bill and bonds, and maybe going into stock market. Again, it's also expected that Nigeria stock market, we have our own fair share of losses as the debt market continue to become more lucrative for people with little or no risk. So it's a decision that has been made. If the other way would have cautioned the authorities to exercise patience in going all aggressive. And the question is, what brought us here in the first instance when it comes to inflation? I think what brought us here when it comes to inflation is the sporadic devaluation of Naira that was not properly thought through before it was devalued. Before Naira was devalued, 15th of June, exchange rate parallel market was 830. At official rate, it was 420. Subsidy is gone on one hand, which of course changed reality and the economic life of many Nigerians. That was May 29, coupled with 15th of June, where Naira was badly devalued. Today, we are seeing that the same central bank that took her hand off the market is now coming back to the market, supporting the BDC. And this is what we have always said.
But in this instance, the CBN is saying that
you have a lot to do with as individual.
The CBN sees it as a trade-off, and they are maintaining that its core mandate comes first. What do you make of the CBN stance?
CBN never said anything that is wrong. It's a trade-off. But in economics, and this is why you see you need to read economics beyond first degree. You need to study economics to advanced level of knowledge, because basic economics, elementary economics, we say is a trade-off. Once you increase interest rates, it may likely have impact. Now, at advanced level, we now need to measure. We need to measure how much of the economy, overall economy, will this affect. Again, if we continue to increase interest rates, it may hamper GDP growth. When it hamper GDP growth, it may now be counterproductive to inflation. So rather than inflation taming, it may even increase. And that is why we think that economic theorists must understand that classical approach has its limits. As Keynesian school has written and published a lot of books to say there are limits to classical approach or classical economic approach has been adopted, especially by the monetary economists in Nigeria today.
All right, let's look at the asymmetric corridor and cash reserve ratio of merchant banks, which were adjusted. What is the implication of these decisions, and what do they portend for the people?
Well, first, you are going to see that merchant bank, we have also joined their commercial counterpart. They are going to now give more of their reserve to the Central Bank of Nigeria. That means the ability to lend, including the asymmetric corridor, is also going to be affected. What that means is, by all means, liquidity in the system will significantly be stifled. And when liquidity is stifled in the system, Central Bank on one hand, we say it's achieving our aim. And what is the aim? The aim is to control money supply. On the second hand, the review sector will also suffer. We now need to answer this question. Do we continue to use monetary tools to combat inflation, which is primary method of combating inflation, or should we consider what exactly it has led or has induced inflation? And I can tell you, the Bureau of Statistics report reveal that is that report that Central Bank relies on. So the Bureau of Statistics reveal that when it comes to inflation, food inflation has more potency in Nigerian inflation today. So when you mop up money from circulation and you are not producing, your supply side is lean, then what does that mean? I can tell you, America has been faced with that kind of problem, not just only in America, even Germany and the rest of Europe have been faced the kind of problem Nigeria is faced with today. They understood, they tried some of this method of increasing interest rates, using classical approach, but they all failed. Even when it appears that the economy is adjusting, they all failed. What should we be doing? We must understand that our real problem lies on supply side. How do we boost our grain production from current less than 300,000 metric tons a year to about 1 million metric tons a year? This is what we consume. We need to boost output. We need to improve productivity. We need to boost exports. If we don't do all of these, at best, all our methods will be interventionist in summary.
Paul, thank you very much for speaking with us.
Thank you so much for having me.